It is 6:30 in the morning. You are standing in your kitchen, coffee in hand, and before the cup even gets to your lips, you open the Fidelity app on your phone. Habit. It has become a habit. The screen is red, not a little red. The S&P 500 is down hard, and somewhere in that portfolio you spent 30 years building, tens of thousands of dollars have evaporated overnight. Your stomach does that thing. The clench. Not because you do not understand that markets go up and down. You do understand that. You have heard it 100 times. The clench happens because you just remembered the property tax bill is due next week. And now you are standing there, finger hovering over the sell button, doing math you never wanted to do at 6:30 in the morning. How much do I actually need? Can I sell just part of it? Is this the bottom, or does it get worse? This is the moment that financial advice always skips over. Every advisor, every YouTube channel, every article says the same thing. Be patient, stay the course, the market always comes back. And in theory, they are right. The market does come back. But that advice was written for people who are still accumulating. People who have a paycheck coming in on Friday. People who do not have to touch that portfolio to keep the lights on. If you are retired or close to it, the rules of the game just changed completely, and nobody told you. The fear you feel right now is not irrational. You are not being weak. You are just using an accumulation tool in a decumulation world. That is a mismatch, not a character flaw. So today, I am going to walk you through the data that shows exactly why just hold on can quietly destroy a retirement portfolio and what a different kind of system looks like, one that lets you stop opening that app in dread. If that sounds useful, hit subscribe. This is exactly what this channel is here for. Let me give you a math problem, not a complicated one, just an honest one. Two people retire on the same day, same age, same portfolio, $1 million. Same plan, withdraw $60,000 a year to cover living expenses. And over the long run, their investments average the same annual return. Identical on paper. The only difference is timing. Person A retires into a down market. Year 1, the portfolio drops 15%. Person B retires into a calm stretch. The bad years come later, around year 10. Same average return, same withdrawal amount, same starting balance. Person A runs out of money in their early 80s. Person B ends up with more than they started with. That is not a hypothetical I made up. That is what Vanguard's research on sequence of returns shows repeatedly. The order of your returns matters just as much as the returns themselves, and in retirement, a bad sequence at the wrong time is not a temporary setback. It is a permanent one. Here is why. When you are still working, a market drop is a paper loss. Uncomfortable to watch, but the portfolio stays intact. You do not sell. You wait. The market recovers. Your shares come back with it. But the moment you are withdrawing money to live on, the math shifts entirely. If the market drops 20% and you need to pull out $60,000 to cover your bills, you are not just selling at a loss. You are selling a larger number of shares than you would have at a higher price. Those shares are gone, permanently. When the market recovers, you are not riding the full wave back up. You are riding a smaller wave on a smaller base with less fuel. Every year you withdraw from a down portfolio, the hole gets harder to climb out of. I do not have a crystal ball about exactly when the next correction lands in 2026, but the math does not care about my predictions or yours. It just runs. And here is the part that most retirement planning still glosses over. The anxiety makes it worse. When you watch your balance drop month after month, and you know that rent, insurance, and groceries are coming out of that same account, a quiet pressure builds. Even disciplined investors start second-guessing. You check the app more. You read more headlines. The urge to do something grows. And that urge, acted on at the wrong moment, is what turns a manageable loss into a permanent one. The numbers on the screen did not break the retirement plan. The forced choice between paying your bills and staying invested did. That is the actual trap, not the market, the structure. And that structure is why the standard be patient, stay the course advice, which is genuinely good advice for a 45-year-old with a paycheck coming in, becomes something closer to dangerous for someone who is drawing down their savings every single month. The market numbers on your screen are not what breaks a retirement plan. The moment you are forced to sell because you have no other option, that is what breaks it. So we have established the trap. Withdrawing from a falling portfolio permanently damages your ability to recover. The sequence of your returns is not a minor detail. It is the whole ballgame in retirement. But here is where it gets more complicated, because there is a second fear running alongside the first one, and it pulls in the opposite direction. Some of you are not panicking because the market is down. You are panicking because the market is up. The S&P 500 has been hitting all-time highs. The Magnificent Seven stocks have been driving a concentration of gains that makes the whole thing feel fragile, like a tower that is too tall. And your brain, doing exactly what brains are designed to do, is flashing a warning signal. This cannot last. Get out before it falls. So you think about moving to cash, sitting on the sidelines, waiting for the inevitable correction, then buying back in at the bottom. It sounds logical. It feels like the smart move. It is almost never either. Here is what JP Morgan's Guide to Retirement data shows, tracking markets from 1988 through today. If you had invested a lump sum on a completely random day, your 5-year return would have been positive about 68% of the time. But if you had invested specifically on a day when the market hit an all-time high, your 5-year return was positive about 80% of the time. Let that sit for a second. Buying at the top of the market, the exact moment that feels the most terrifying, has historically produced better outcomes than buying on a random day. The reason is simple. All-time highs tend to cluster at the beginning of continued growth cycles, not at the end of them. Your instinct and the data are pointing in opposite directions. And then there is the cost of waiting. Dalbar has been tracking this for decades. The S&P 500 has returned roughly 10% per year over the long run. The average individual investor has captured about 5%, half. The gap is not explained by bad stock picks or high fees. It is explained almost entirely by behavior, selling during drops, waiting too long to get back in, and missing the 10 or 20 days of sharp recovery that account for most of the annual gain. You do not have to miss many of those days to cut your returns in half. Cash feels safe, and in the short term, it is. But sitting in cash for a year while inflation runs at 3% or 4% means your purchasing power is quietly shrinking. You are not avoiding risk. You are trading one kind of risk for another, short-term volatility for long-term erosion. That is a trade-off worth naming clearly. Volatility is visible. You can see it on the screen. Inflation's damage to your cash is invisible until it is not, until the grocery bill is 20% higher than it was 3 years ago, and your money market account has not kept pace. So where does that leave us? Holding through a down market feels dangerous because you need cash and the portfolio is bleeding. Moving to cash feels dangerous because you might miss the recovery and lose ground to inflation. Both options carry a real cost. This is not a psychology problem you can just think your way out of. This is a structural problem, and structural problems need structural solutions. If holding requires you to sell when you need money, the problem is not your discipline. The problem is that your living expenses and your investment portfolio are sitting in the same bucket. That is the design flaw. Fix the structure, and the emotional pressure mostly disappears on its own. I want to tell you about a client I sat with in 2022. The market was down hard that year. I had been doing this long enough to know the script. Stay calm, stay invested. This is temporary. I believed it. I still believe it. But this person was not sitting across from me asking about returns. They were sweating, literally. because they needed money for a medical bill, the kind that does not wait for a market recovery, and their entire liquid net worth was sitting in an account that was down 20%. They had done everything right by the old playbook. Diversified, long-term mindset, no panic selling for years. And now they were cornered, not by the market, by the structure. That was the moment I stopped treating stay the course as a complete answer. It is not. It is half an answer. The other half is making sure you are never forced to sell at the worst possible time just to keep the lights on. That is what the emotional black box is. The concept is straightforward. You take 2 to 3 years of living expenses and you move them completely out of the market into assets that do not fluctuate with the S&P 500. Money market funds, short-term treasury, ETFs like SGOV, instruments that preserve your principal and currently yield somewhere around 4.5% to 5% annually as of early 2026. If you need $60,000 a year to live on, your black box holds $120,000 to $180,000. Fully liquid, completely separate from your investment portfolio. Now do the math on what that changes. When the market drops 20%, you do not open the app and feel that stomach clench. You open it, you see red, and then you remember, my bills are paid for the next 2 years. I do not have to touch a single share. I can just wait. And waiting, when you are not forced to sell, is no longer a test of willpower. It becomes the obvious move. Your investment portfolio, the remaining 80% or so of your assets, is now free to do what it was designed to do: recover, compound, and grow without you interrupting it at the worst possible moment. The black box buys your portfolio the time it needs. There is a real cost to this, and it is worth being honest about it. That $120,000 to $180,000 sitting in a money market fund is not in the S&P 500. In a strong bull year, it will underperform. That is cash drag, and it is a genuine trade-off. You are giving up some upside on a portion of your assets. What you are buying in return is behavioral alpha. The return you actually capture because you did not panic sell. Research consistently shows that the gap between what the market returns and what investors actually receive comes almost entirely from behavior, from selling low and buying high under pressure. Eliminating that pressure is worth more than the cost of the cash drag almost every time. I have watched people hold through 2020, through 2022, through every correction in between, not because they had extraordinary discipline, but because they had a system that removed the need for discipline. The bills were covered. There was nothing to panic about. That is the whole point. You are not trying to be a better investor. You are trying to build a system where being a bad investor during a crash does not matter because you are not making any moves during the crash anyway. When you have that structure in place, something shifts. Market volatility stops being a threat to your month. It starts looking more like an opportunity, especially heading into the end of 2026. Here is something I got wrong for a long time. I used to think the smart move with a traditional IRA was to leave it alone as long as possible, let it grow, defer the taxes, keep the government's hands off it for as many years as you can. That logic made sense to me for a long time. But December 31st, 2026 changed how I think about that entirely. That is the date the Tax Cuts and Jobs Act sunsets. The lower tax brackets most Americans have been operating under since 2017, the 12%, 22%, and 24% brackets are scheduled to revert. Starting January 1st, 2027, those same income levels would be taxed at 15%, 25%, and 28%. On top of that, the standard deduction gets cut roughly in half. This is not speculation. It is the current law unless Congress acts to extend it, and as of now, there is no extension in place. What that means practically, 2026 is one of the last years you can convert money from a traditional IRA to a Roth IRA at today's lower rates. And if the market gives you a dip this year, that dip is not just a temporary loss on paper. It is a discount on your future tax bill. Walk through the numbers with me. Say you convert $50,000 from your traditional IRA to a Roth during a market pullback in 2026. You pay income tax on that $50,000 now at the current lower bracket. That hurts a little, no question. But when the market recovers and that $50,000 grows to $70,000 inside your Roth account, every dollar of that gain is permanently tax-free. No taxes when you withdraw it. No required minimum distributions forcing you to pull it out on the government schedule. It just sits there, growing, completely outside the IRS's reach for the rest of your life. Now flip that scenario. You skip the conversion in 2026 because the market feels uncertain and the tax bill feels uncomfortable. By 2027, the brackets have reverted. The same conversion now costs you more in taxes. And every year you wait, your traditional IRA keeps growing, which means the RMDs you will eventually be forced to take get larger, pushing you into higher brackets at exactly the moment you were hoping to be paying less. Delaying is not neutral. It is a choice with a price tag attached. The reason most people miss this window is not because they do not understand taxes. It is because the two pieces, the market volatility and the tax deadline, feel like separate problems. They are not. They connect directly. A market dip in 2026 means the assets inside your IRA are temporarily valued lower. Converting them now means you are paying taxes on a smaller number. When they recover inside the Roth, that recovery belongs entirely to you. The structure makes the volatility useful instead of frightening. One more thing worth tracking, Dave. The IRS adjusts income thresholds and bracket boundaries annually for inflation. Before you run the numbers on a Roth conversion, confirm the current 2026 figures directly with irs.gov or with a tax professional. The mechanics I described are accurate as of this recording, but the specific dollar thresholds shift each year, and getting that detail right matters. You have probably noticed a pattern by now. The black box gives you the cash flow to survive a down market without selling. The Roth conversion lets you use that same down market to reduce your lifetime tax bill. Bad news, run through the right system. Starts working for you instead of against you. Let me bring this back to that kitchen. 6:30 in the morning. Coffee in hand, red screen. The difference is not that the market stopped being volatile. It did not. The difference is that you built a system where the red screen is someone else's emergency, not yours. Your bills are covered by the black box for the next 2 to 3 years. Your portfolio can drop, recover, and compound without you touching it. Your Roth conversion is already working in the background, quietly reducing the tax bill your future self will have to pay. You are not watching the market anymore. You are just watching your life. That is the actual retirement most people are trying to build, not a number on a screen, not a perfect sequence of returns, just the ability to go play golf, spend time with the grandkids, book the trip, without the Sunday night dread of what Monday morning's open is going to look like. 3 things. That is all this comes down to. Stop withdrawing from a falling portfolio. Build the emotional black box with 2 to 3 years of living expenses in stable, liquid assets. And use whatever market dips 2026 gives you to run Roth conversions before December 31st. You spent 30 years building this. The last move is making sure the structure protects it. If this gave you one thing to think about differently, hit subscribe. More of this every week. See you in the next one.